David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Seth Edgell are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by Seth Edgell, a financial advisor with Keystone Financial Group here in Trussville, for a discussion about recent economic and market trends. Seth, interviews in the past year have discussed the threat of a recession. However, the S&P 500 index has had positive growth this year. Have we avoided economic recession? And are we back to a growth cycle in the economy?
That question has a lot of moving parts, but I will start out by saying that no, the threat of recession has not yet been removed from our economic outlook. Let's start out by breaking down the growth of the S&P 500. Firstly, the S&P 500 is an index created by S&P Global Ratings, formerly known as Standard & Poor's, that tracks the performance of 500 of the largest companies that are listed on the New York Stock Exchange, Chicago Board Options Exchange, or the NASDAQ. While it may contain 500 of the largest companies on those exchanges, it may not contain the 500 largest companies based on size alone. The 500 companies in the index are selected by a committee at S&P Global Rankings based on a number of criteria. This dynamic index that regularly adds and removes companies from the index. Most recently, the index was rebalanced on March 10th, 2023 by removing Silicon Valley Bank Financial Group due to the bank's failure. In addition to the S&P 500 being a dynamic index, it is also a market capitalization weighted index. This means that the more valuable a company is, the more weight that company's stock receives when calculating the return on the index. Since its inception, the S&P 500 has served as a barometer for the overall health of the U.S. economy and large capitalization companies. According to the market research firm Y-Charts, the S&P 500 had a total return of negative 18.11% in 2022. According to S&P Global, this year the index has a total return of 18.91% positive. However, in my opinion, this should not be taken at face value that we have economic recovery, and keep in mind that past performance of the index does not guarantee it will continue in the future. In fact, according to Yahoo Finance, only 7 of the 500 companies in the index contributed for 73% of the growth of the index. These 7 companies are Apple, Tesla, Meta, Alphabet, Nvidia, Amazon, and Microsoft. Due to the cap weighting structure of the S&P 500, these companies make up about 26% of the index. If you remove these 7 companies from the S&P 500, the return on the index would be negative 0.8%. This means we have 7 companies in the index that are growing, while the other 493 companies are relatively stagnant. It was kind of a perfect storm that led to this weird, yet oddly familiar market that we're seeing right now. Due to the high concentration of these 7 stocks in the index, if the market decides that these companies are overvalued, the drawdown in the index would be significant. It is our belief that we have not yet avoided recession or achieved the soft landing that the Federal Reserve is trying to achieve.
Oh wow, I was unaware that economic growth was so unequally concentrated right now. Why are these 7 companies performing so well while the rest of the market is lagging behind? What kind of perfect storm led to these market conditions?
That's correct. I would classify this as an extreme inequity in market performance when analyzing the holdings of the S&P 500. When I mentioned the perfect storm that created this market, I was referring to the unique set of economic conditions that created an environment that allows 7 companies in the index to have extreme growth, while the majority of companies in the index are not growing. In the Magnificent 7, as they have been colloquially dubbed, you have essentially 7 technology companies. These companies are investing heavily in artificial intelligence. Artificial intelligence seemed like a science fiction concept until earlier this year, OpenAI, a Microsoft-owned company, gained popularity due to its chatbot program, ChatGPT. GPT stands for Generative Pre-trained Transformer. Basically, these programs are taught a set of data inputs in its pre-training phase that then transform and generate output in the form of a language model. These programs are in their infancy, but at times they can sound rather human. From this concept, an entire field of new ways to sort, generate, and interpret data was born. Artificial intelligence can be used as a tool to automate mundane tasks, brainstorm, or analyze data sets. Think less Terminator and iRobot, more Jarvis from Iron Man. This will be a tool that will eventually change and revolutionize most aspects of our life. This, in my opinion, is where the problem lies. We have a market that is very excited about a revolutionary technology, and the market does not want to miss the prospect of participating in revolutionary growth. This led to NVIDIA posting earnings numbers and forward guidance that far exceeded market expectations. In addition to this, we have a strong labor market and the Federal Reserve showing signs we may be near the end of interest rate hikes, and underperformance by traditional value companies. The labor market and a dovish Fed are generally good economic indicators, but underperformance in the value sector has forced institutional money managers to invest further in the Magnificent Seven stocks in order to provide positive returns for their funds. To me, this environment is eerily similar of the dot-com bubble of the late 90s to early 2000s. We have a market that is overly excited about a revolutionary technology that we have only begun to realize its full capability. 24 years ago, this excitement was about the internet. While the internet did eventually revolutionize the world, it didn't happen in 1999. The difference that we see in this environment from 1999 is that the dot-com bubble was comprised of unknown companies that no one knew what they created. Many of these companies failed. This time around, the growth is coming from well-known, established companies. I don't believe a market correction would be comprised of a systematic failure of these 7 firms. I just do not believe we are out of the woods when thinking about the possibility of a recession.
Well, what should investors do to protect themselves from a drawdown in their retirement? If these stocks are growing, should investors invest heavily in these companies? What facts do you think point to the possibility of a recession?
For our clients, risk mitigation involves many variables and considerations. For example, time horizon, need for liquidity, and a client's appetite for risk are a few of the factors we consider when discussing mitigation of risk. Before someone invests heavily in any variable investments, I would recommend consulting with a professional to make sure investments fit into their holistic financial plan. As far as a recession is concerned, the Federal Reserve is not yet done with raising interest rates or quantitative tightening. The M2 money supply is at a historic level and needs to continue to fall. Inflation is improving, but we have not yet reached the Fed's target of 2% on the PCE deflator. Domestically, the majority of Americans are living paycheck to paycheck. Globally, we have geopolitical instability and much higher inflation abroad. While the measures the Fed is taking are currently working and a soft landing looks like it could be a possibility, historically the Fed has never been able to raise interest rates to control inflation without pulling the economy into a recession. It is impossible to predict future returns, but I would encourage viewers to err on the side of caution and, most importantly, consult with a professional fiduciary financial planner to make certain their portfolios and financial plan are working towards their goals. Any solid financial plan should plan for growth and wealth accumulation while making thoughtful attempts to mitigate all risks to the plan.
Well, thank you, Seth, for the insight and market outlooks. I was unaware there was such a vast dichotomy in the growth of the companies in the S&P 500.
Thank you for allowing me to be a resource. If I had one takeaway that I want viewers to have, it is that when investing, it's important to analyze the facts to avoid making irrational decisions based on fear, anxiety, or opinions.
Seth, as always, thanks so much for this information. And for additional information, Seth may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brannon Dawkins.
David Guttery and Seth Edgell independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.